Hello and welcome to Session 5 of the Basic Tax course. We're going to begin Session 5 with a review of the Session 3 quiz answer key. And here I have the questions from the Session 3 quiz. And is customary, I am going to review the most frequently missed questions, beginning with question number 1, which was the most frequently missed question. Mr. G worked at Zippy Restaurant and received $30 in tips for 1 month. That same month, he also worked at Eater's Restaurant and earned $15 in tips. Mr. G must report tips to both of his employers. Well, the answer to this question is false, and here is why. The word is must. And remember, must means you are required. And he is not required to report tips to both his employers. He is required to report required to report tips to his employer when, while working for that employer in any 1 month, he earns $20 in tips or more. So if he receives $30 in tips working for Mr. G at Zippy Restaurant, then he would be required to report those tips because they are $20 or more. But at Eater's Restaurant, if he only earns $15 in tips for the month, that is less than $20, therefore he is not required to report them. So the question is, he must report to both his employers? That answer is false. He only needs to report to one employer. Number 2, tip income is always includable in gross income, even if the amount received is less than $20 per month. Well, that is true, and many students feel that 1 and 2, quiz questions 1 and 2, contradict each other, when in fact that is not the case. They are basically questioning 2 completely different concepts. The first concept in question number 1 has to do with reporting requirements. Am I required to tell my employer I received these tips? That's a separate issue entirely from, am I required to include this tip income on my tax return and pay tax on it? And question number 2 is surrounding this issue of taxability. If I receive a tip in a month, or if I receive less than $20 in tips in a month from my employer, they're not taxable. That's often a way of thinking, but it's actually incorrect. If you receive $1 in tips during the month, you're still required to report it on your tax return. There's no minimum amount of money you're allowed to earn and pay no tax, at least in that regard. So you have to report it. Therefore, tip income is always includable in gross income, even if the amount received is less than $20 per month. That is absolutely true. So if you receive a $5 tip, if you receive a $50 tip, if you receive a $2 tip, the law says you have to include it in your income. And where do you include it? You report it on line 7 and include it as wage income on line 7. The next most frequently missed question is moving on to page 2 of the quiz. That was question number 7. An employee who has received total tips of $20 in 1 month by working at 2 separate employers must file Form 4137 to pay Social Security and Medicare taxes on unreported tips. And the answer to this question is false. This is kind of a tricky question. It's false for 2 reasons. The first reason is if you receive $20 in 1 month by working for 2 employers, then you would have had to have received at most $19 from one employer, say, and $1 from the other, which means in neither case did you make $20 or more in tips for any one employer, so you're not required to report to them. The second issue is it has to do with paying the tip tax, and Form 4137 is used to pay tax on tips. However, even if you receive $20 in tips or less than $20 in tips while working for an employer, if you reported those tips to your employer, you don't need to prepare Form 4137. So let's read this problem again. An employee who has received total tips of $20 in 1 month by working at 2 separate employers must file Form 4137 to pay Social Security and Medicare taxes on unreported tip income. Well, that's assuming that the tips weren't reported, A, and B, even if they weren't reported, you only have to file Form 4137 to pay the tip tax if in any 1 month you received $20 or more from a single employer, and this problem says it was $20 from 2 employers. Number 8, your divorce decree states that your ex-spouse shall pay you $1,000 per month until your child reaches 18, when payments shall reduce to $500 per month. During the year your ex-spouse fell behind on support payments, you received support payments totaling $7,000 for the year, and which of the following statements is true? Well, we're looking at a couple of things here. One is child support and one is alimony. And the first job you have as a tax preparer is to determine what portion of the payment is deemed to be child support. Well, when we look at it, we say, okay, the payment is called alimony, and the divorce decree says it's alimony, but the divorce decree also contains a contingency that ties an alimony payment to the child. How is it tied to the child? It's tied to the child because it is contingent upon an event relating to that child. And the event is the child turns age 18 and the alimony drops. And because the alimony drops based on a contingency surrounding a child, that means that that portion of the alimony payment is not alimony and is in fact child support. The second thing we look at is that under IRS rules, child support is always considered to have been paid before alimony. So if the divorce decree stipulates that $1,000 should be paid per month, and we then say $500 of that is actually child support, and that the child support gets paid first, then we would simply go 500 times 12 months equals $6,000. So $6,000 of the $7,000 is child support, and that means only $1,000 of that $7,000 total is alimony. And the correct answer, therefore, to question number 8 is A. You should report $1,000 as alimony income on your tax return for the year. Next question in line was question number 10. You have won and received a $10,000 scholarship to OHSU for academic years 2010 through 2014. You are a full-time student and a degree candidate. For academic year 2010, you received $2,500. During 2010, you spent $1,500 on tuition, $700 in books, and $2,000 on room and board. How much of your scholarship is taxable on your 2010 tax return? All right, so here's what we're looking at. A scholarship is non-taxable to the extent it's spent on qualifying education expenses. Qualifying education expenses include the cost of books, supplies, fees, and tuitions. And so what you're looking at in this equation is how much of the $2,500 for 2010 was spent on qualifying expenses. Well, we see $1,500 was spent on tuition and $700 was spent on books. So that's a total of $2,200 that was spent on qualifying expenses. So if I take and just say $2,200 was spent on qualifying expenses, then I'm interested in how much was received. And the difference between what was received and what was spent is $300. And that's where we get the correct answer being answer number A. So the total amount of qualifying expenses was $2,200. The total amount of scholarship received was $2,500. The difference between those is $300, and $300 is the amount that gets reported as income. Now there is a second or a third number provided in here which says $2,000 was spent on room and board. There's no reason whatsoever to assume that the scholarship was allocated to the room and board, and in fact it doesn't matter. What matters is that there were qualifying expenses, and the qualifying expenses totaled $2,200. The next most frequently missed question was question number 12. Which of the following would disqualify a taxpayer from filing Form 1040? Well, actually, your taxable income has to be under $100,000, so certainly $50,000 of gross income would not disqualify you. But it happens to be the case that there is no line to enter alimony on Form 1040A, so if you paid or received alimony, you would need to file the long Form 1040. And obviously you can enter dependents on 1040A, and well, accident insurance proceeds typically aren't taxable to begin with, so you don't need to worry about putting those on a return anyway. Number 13, John got lucky in Las Vegas. He won a $5,000 jackpot and won an additional $400 playing blackjack. He also lost $1,000 at the track. How much gambling income should John report on his tax return? Well, this is a most frequently missed question, and I'm sure that what's going through the minds of the students is that, hey, he had this loss, I'm going to subtract 1,000 from the 5,400 of wins, and basically say, oh yeah, he has to report 4,400 of taxable income. Unfortunately, that is not how the IRS views it. IRS says you need to report the gambling winnings in full on line 21 of the Form 1040. And then if you are going to claim losses, you claim those losses as an itemized deduction on Schedule A. And we'll get to how to claim itemized deductions on Schedule A later on in our course. But for now, it's safe to say that the correct answer to number 13 is C, $5,400. Next question is question number 14. To know how much federal income tax to withhold from employees' wages, you should have a Form W-4 Employees Withholding Allowance Certificate on file for each employee. Which of the following statements is true relating to Form W-4? Well, there are three different statements that are provided. And let's look at number A first. An employee who claims exemption from withholding must renew their exemption each year by February 15th. That is a true statement. Exemption simply means you are telling your employer that your income and deductions are such that you owe no income tax when you file, and therefore you should have no withholding. You're exempt from withholding because you just simply don't pay tax. But that status has to be reaffirmed each and every year that you are still in a situation where your income and deductions are such that you don't pay tax. But the second one, B, all employees must renew their Form W-4 every year. That is not true. Form W-4 is typically filed when you first take up your job with your employer to tell your employer how much to withhold for you. And it would be normal and necessary to file a corrected W-4 or an updated W-4 if you get a second job, if you get married, if you buy a house, if you have children. There could be some factors that occur that would make it so that you should change your W-4 and resubmit a new one to your employer. In fact, as a tax preparer, I frequently work with my clients evaluating the amount of taxes they're having withheld, and sometimes assisting them with filling out corrected W-4s because they've either been really over withholding or very often, more often the case, under withholding taxes, and I'm essentially helping them with a W-4 to ensure that they are having the correct amount of tax withheld. And then finally, number C, if an employee does not provide you a Form W-4, you may not withhold taxes from their wages. Well, this is basically completely untrue. Employers are required to withhold taxes from employee wages, and they are also required to have their employees sign Form W-4 and submit it to them. So as an employer has very much legal requirements and responsibilities. But let's just suppose an employer has an employee who won't fill this form out or doesn't fill the form out. It doesn't mean that they don't have to do withholding. They definitely do have to do withholding, and an employer is responsible for that to such an extent that if they are required to do withholding and do not, the IRS can go after the employer and make them pay taxes that they should have withheld and did not. Pretty serious stuff. Moving on then to the next most frequently missed question, and that was actually the mini problem, and it's normal for students to have some challenges surrounding the mini problem. This was a pretty elementary mini problem, but it still resulted in most students missing question number 18. Neelix weighted tables at Planet Earth Alliance for all of 2010, and he had no other source of income for the year. He did not keep a tip record. Planet Earth Alliance issued Neelix the following Form W-2. Prepare Form 4137 for Neelix and answer questions 18 through 20. So what do we care about when we're looking at this particular W-2? Well, we're looking at the boxes and making sure we understand the meaning of what's in them. Box 1 shows total wages and tips for the year. Box 3 shows what portion of those wages were wages. And Box 7 shows what portion of the Box 1 income is from tips. So tips plus wages equals the total wages. And then Medicare wages are the equivalent of the regular wages. Over in Box 8, we have allocated tips. And I've just finished telling you in the problem that Neelix did not keep a tip log. And since he did not keep a tip log, he is going to have to report those allocated tips and pay tax on them. So just thinking ahead to what's going to happen on the Form 4137, we're going to see that he's going to have to pay tip tax on $5,000, and he's going to have to pay income tax on $28,000 plus $5,000. So let's go take a look at his finished 4137. There we are. So here is the 4137 for Neelix, and it shows that his employer is Planet Earth Alliance, and it shows the total cash and charge tips that he received for the year. Remember, the income shown in Box 1 was $28,000, but only $18,000 of that was tips. So we're going to look at the $5,000 of allocated tips and add those to the $18,000 of reported tips, and that's the total tips that he received for the year. Now, what portion of the total tips received for the year were reported? Well, 18 were reported, and the difference between 18 and the actual tips earned, according to IRS, is $5,000. So the calculation for the tip tax is made on that. We have $310 of Social Security tax that is assessed, $73 of Medicare tax, and the total tax owing for tip tax purposes is $383. So if you have any other questions regarding the Session 3 quiz, please use the Q&A forum for Session 5 to post questions about the quiz. Be sure to identify the quiz question and why the answer key did not help you understand the answer to that quiz question, and we'll be happy to assist you with learning more about those problems. I'm moving on now to the next topic of the day, which is a review of the Session 4 homework answer key. And remember, the Session 4 homework assignment involved a character named Sally Price, who is receiving $500 a month in alimony. We can right now in our mind say, okay, 500 times 12 months, that's going to give us $6,000 of alimony, and I think that goes on line 11 of the 1040, so I've pretty much already figured in my mind where I'm going to put that number. The next problem we come to is the 10-year-old niece and what to do with her. She lived with Sally for 10 months. She is a niece. She is related. So she's going to meet the definition of qualifying child. She will qualify Sally for head of household and also for the child tax credit. So mentally in the mind on the 1040 form, I'm going to check the head of household box. I'm going to enter a dependent, and I'm going to check the child tax credit box. Next, we have Sally received $30 of jury pay and $15 of interest on her savings account at XYZ Bank. $30 of jury pay belongs on line 21, and the $15 of interest belongs on line 18, line 8B of the 1040. And in fact, I keep referring to the 1040, so why don't I just open one up here and make it a little bit easier for you to follow along with me. So we have the alimony that would go on line 11. We have the interest income, actually doesn't go on line 8B, it goes on line 8A, sorry about that. And we have the jury pay that goes on line 21. So that's where we are so far in this problem. She also received a K1, which we need to take a look at, and she's going to qualify for the Making Work pay credit in the amount of $400. So let's take a look at our W-2. We have $35,000 that we know will carry to line 7. And on the K1, we have more information. The first thing we see is that there's $1,500 of rental income. Happens to be the case that rental income is reportable on line 17, so I know that we're going to have to carry a number to line 17, but because a K1 was issued, we're also going to have to attach a Schedule E page 2 to Sally's tax return. And the interest income of $1,500, well, remember I had said we've got $15 on line 8A. Well, now we've got an additional $1,500, so that means the total to enter on line 8A will be $1,515, and because we're over $1,500 of interest income, we will need to attach a Schedule B, and we will also use Schedule B to report the $100 of dividend income, which incidentally will carry to line 9. So let's take a look at Sally's finished tax return. I'll pull up the answer key for it now. And here we have it. So we can see the head of household filing status. We have the dependent Mary Tate. We can see that the child tax box, or the child tax credit box, is checked. There's the wage income from the W-2, the interest income, the dividend income, the alimony income, the rental income from the K-1, and the jury pay. So all of that should make sense to you. And the next step, of course, is to fill out the correct attachments. And the first attachment that we need to put on the return is a Schedule B, where we identify the source of the interest income and the source of the dividend income. I wanted to point out that we also are required to answer the questions in Part 3 regarding foreign trusts and bank accounts, and the answer to both those questions is no. Moving on to Schedule E, page 2, we list the name of the entity that issued the K-1, and that is ABC Investment Group. ABC Investment Group is a partnership, and so we enter P. We then enter the employer ID number that appeared on the K-1. Rental income is passive income, and passive income is reported in the passive column. So we report that as a passive income amount, and it's the only income that actually flows through to the K-1. So if you were confused and wondered, do I put the interest income that was on the K-1 somewhere on Schedule E, page 2, the answer is no. The income retains its character and flows to the appropriate schedules. And passive income is reported on Schedule E And some non-passive income is also reported on Schedule E, page 2. But interest income is always reported on line 8 and therefore carries through to the Schedule B and not to the Schedule E. So going back up to page 2 of the 1040, we finished this return off by showing the head of household standard deduction, 2 personal exemptions that total $7,300, a tax bill of $36.66 that is reduced by the child tax credit down to $26.66. We have $5,000 of withholding, a $400 making work pay credit, and when we're all said and done, we have a $2,734 refund. So that concludes the review of the Session 4 homework answer key. And if you have any questions regarding the Session 4 homework answer key, please post those in the Q&A forum for Session 5. And remember, when you post a question in the Q&A forum, to please be very specific about what it is you don't understand and why the answer key was not specific enough. And we will provide you with additional information to help. At this point, you should push pause on video playback and begin taking the Session 4 quiz. When you are finished taking the Session 4 quiz, please resume video playback for the Session 5 lecture. Hello and welcome back to Session 5. At this point, you should have finished taking the Session 4 quiz, and if you have not, please push pause and do so. And normally I don't give you a password at the very beginning of a session, but today I feel like I will. And the password for the Session 3 quiz answer key is Space Station. So please jot that password down and use it to unlock the Session 3 quiz answer key. And it is also one of the passwords for today's password test. Today's topic is pension income. We started talking a little bit about the type of income you get when you were retired in Session 4, because Session 4 is where we introduced you to Social Security income. Today we're going to focus on pension income almost exclusively. However, I will review the Social Security benefit worksheet with you a second time, and you will see at the end of today's class your homework assignment is going to involve a Social Security benefit worksheet. Social Security benefit worksheet is an important worksheet that is filled out very frequently in the real world of tax preparation, so we want you to have a thorough understanding of it. We also think that Social Security topics will be more than likely to be included on the federal IRS exam, so we feel it's an important topic that you should know a lot about. In having said that, pension income is equally important to understand, and it's a very in-depth topic, so we're devoting all of today's session to retirement plans. So let's look at the objectives of today's session, because really by the time we're finished with today's session, you as a student really should be familiar with these very key areas, and if you are not, then I would recommend you take this session again. Pension income is one of the more intimidating sessions for most students, and by that I mean that if you find at the end of today's class you found, whoa, I don't understand this, I'm confused beyond all get out, that would be a normal response. Even as a tax professional, I have to say that I found pension income to be quite confusing until I'd been in the industry for 3-4 years on a full-time basis. It's just difficult for me to wrap my head around. Now, having said that, if you are retired and you do have pension income, you may have figured a lot of this out already, but if you're a young person who is not yet retired, pension income may seem a long ways off and not as relevant to you, and that would be why for younger people, pension income is often more of a challenge to learn than it is for some of our some of our students who are actually already retired. So by the end of today's session, as a student, we would like you to be able to interpret information contained on Forms 1099-R and 5498. You should be able to calculate the taxable part of a distribution from an IRA using Form 8606. You should be able to understand the special rules that affect 2010 conversions and rollovers to a Roth IRA. Know when an early distribution is subject to the 10% early withdrawal penalty and exceptions to the penalty. Be able to determine the taxable part of a distribution from an annuity using the simplified method rule. And know how to complete Forms 8606 and 5329. So that's a lot to cover in a single session. We're going to begin, though, by looking at employee pensions and annuities and introducing two terms to you. They are two definitions that you should know and become very familiar with and instantly understand what they mean whenever you hear them. The first of those words is contribution. A contribution means to put money into your retirement account. And the second word is distribution. Distribution means to withdraw, take, or receive money from your retirement account. So if you're going to deposit or put money into your retirement account, we call that a contribution. And if you are going to withdraw or take money from your retirement account, we call that a distribution. Your distribution from your retirement plan may be partially or fully taxable. To be partially taxable, you must have made after-tax contributions to the plan or annuity. Your after-tax contributions are your cost in the plan. Your distribution from your retirement plan will be fully taxable if either of the following is true. You made only pre-tax contributions, or your employer paid all of the costs of the contributions for you. Well, let's think a little bit about a Form W-2. And I'm kind of winging it here for a minute. Let me see if I can find a W-2 for you, because I think we should look at this together as a part of, actually I know where I have a W-2. So to help you have a better understanding of what it means to have a cost basis in an IRA, I'm going to show you a W-2 of all things. And the reason I'm going to show you a W-2 is that a W-2, usually when a person participates in a pension plan at work, the W-2 will indicate that that is the case. So if you participate in your employer's provided pension plan, your employer will give you a W-2, and the W-2 will typically have the retirement plan box checked. Now, if you have a pension plan at work, you typically have the option to contribute money to your retirement account. So let's just suppose you do have a pension plan at work, and during the year you can make contributions to your pension plan. Well, if you have a pension plan at work and you made contributions, your W-2 will show a code D right there in box 12A. And if you made a contribution, it should also show you the amount. So let's just suppose that during the year you had a job, and at that job you contributed $5,000 to your 401k plan. Well, the way it actually works on the W-2 is that your contributions to your 401k plan are deductible to you. So let's suppose your annual pay is $50,000, but because you made contributions to your 401k in the amount of $5,000, only $45,000 of your income will be taxed. So you'll end up with a W-2 that shows you made $50,000 of Social Security wages for the year, but only $45,000 of taxable income for the year, because $5,000 has been diverted to this 401k plan. Well, you've put $5,000 into your 401k, but for tax purposes you do not have a cost basis in that $5,000 because it was deducted from your income up here. So what that means is if at a later point in time you pull that $5,000 from your pension plan, it will be fully taxable because it was not previously taxed. So now let's suppose you don't have a pension plan at work and instead you open up an IRA, or maybe you do both. You have a pension plan at work and you have an IRA, and you decide to make contributions to your IRA. If you make a contribution to your IRA and you are able to claim a tax deduction because you did, then you do not have a cost basis in your IRA because you took a deduction for what you put in it. But in certain situations, you can put money into an IRA and you don't deduct it. And there can be a variety of reasons why you do not claim a tax deduction for the money you put into your IRA. But the key point being you did not take a deduction. So if you put money into your IRA and you do not claim a deduction for it, then subsequent to that, you now have a basis. And later on, when you begin to take distributions, those distributions may be partially taxable or in some situations not taxable at all. So to have a basis in your retirement account or in your IRA account means that you used after-tax dollars to make the contributions. If you used pre-tax dollars, and the dollars being pre-tax because they were subtracted from your pay on your W-2, or because you claimed a deduction for them on your tax return when you put them in, either of those two situations means you do not have a basis. So it is important to bear in mind whether or not you're client has a basis in the retirement account or not. And most of the time, people don't have basis, or they have a minimal basis. But it's common enough to actually have a basis that it's really crucially important that you understand how to establish if there is a basis and then determine what that basis is. So let's go back and read this sentence again. That long explanation has just been about trying to help you gain an early understanding to the meaning of this sentence. Your distribution from your retirement plan will be fully taxable if either of the following is true. 1, you made only pre-tax contributions, as through your W-2, or your employer paid all of the costs of the contribution for you. And that means that you didn't make any contributions to your plan at all, and your employer did everything. And of course, if your employer did everything, you have no cost in that either. Form W-4P, withholding certificate for pension or annuity payments. This form is for U.S. citizens, residents, or aliens, or their estates who are recipients of pensions, annuities, including commercial annuities, and certain other deferred compensation. Use Form WP to tell payers the correct amount of federal income tax to withhold from your payments, if any. So essentially, Form W4 is given to an employer to tell your employer how much tax to withhold. When you are retired or are taking retirement income from a pension plan, you complete W4P and submit that to the administrator of your plan so that they can do the appropriate levels of income tax withholding. Another word for you to know is cost. That means your investment in the contract. Before you can figure out how much, if any, of your pension or annuity benefits is taxable, you must first determine your cost in your plan. Your total cost includes the amount you paid and amounts your employer paid that were taxable at the time paid. In other words, none of the contributions were deductible or excluded from income. So remember that W-2 I just showed you a minute ago, where it showed that you had $5,000 of income that was deferred to your pension plan and you were not taxed on it. That money that you deferred to your plan is not your cost in the plan. It's money you invested in the plan, but it was done with pre-tax dollars, and therefore you have no tax cost. On the other hand, if you had a type of plan where you made contributions and took no deduction for them, then you would have a cost, and your cost would be equal to the amount of money that you contributed that was previously taxed. Let's take a look now at Form 1099-R. 1099-R is an incredibly common document that you need to be really familiar with because as a tax professional you will see it often. And it has very specific meanings to each box, just as a W-2 has very specific meanings. And so it's your job as a tax preparer to know what to do when numbers appear in certain boxes. And I'm going to quickly point out the most important boxes. Box 1 is the gross distribution box. And it tells the IRS how much money you took as a distribution from your pension plan or your IRA. Box 2A shows the taxable amount. Now, I would say, at least with my clients, about 30% of the time the taxable amount box is blank. And when it is, the taxable amount not determined box is checked. When the taxable amount not determined box is checked, it means that the administrator of the plan does not know what your cost is. Therefore, they cannot calculate what the taxable amount is. And if the administrator doesn't know what the taxable amount is, then it's the job of the taxpayer with their tax preparer to figure that out. And today's class is going to cover or spend quite a bit of time talking about how we figure out what that taxable amount is going to be. Now, occasionally you will see that the total distribution box is checked, and it simply means that they completely emptied out that plan. So it wouldn't be at all uncommon to get box 1 with a number in it, box 2A blank, and box 2B and total distribution both checked. Easily happens. The EIN of the plan administrator appears in this box, and then the Social Security number of the recipient goes in this box. There is a box 3 which has to do with capital gain income, and that's a very rare situation where you have a tax filer who was born before 1936 and began working for their employer before 1974. I almost never seen a number in this box. Box 4, federal income tax withheld. If there was tax withholding, that box will have a number in it. And if the employee did make contributions to the plan and has a basis in the plan, The portion of the amount of the distribution for the year that is not taxable because it is attributable to their basis typically appears in box 5. So by that I mean, I'm just going to kind of wing this as I go a little. Let's just suppose during the year you had a gross distribution of $10,000, and box 2 has a taxable amount of $9,000, and essentially the plan administrator is saying that $9,000 of the $10,000 is taxable. Then typically the reason for that would be that you have a cost basis, and that cost basis should be the amount showing in box 5. This is not pure science. They don't always exactly equate that way. It seems logical that 5 plus 9 would always equal 1. It is not the case. But very often, when you do see a number in box 5, it does cause box 2 plus box 5 to equal the amount in box 1. The next box to be concerned with is box 7. This is where the distribution code is entered, and it is your job as the tax preparer to know what those distribution codes mean. And there are a lot of different distribution codes. We're going to go through them today. I'm going to provide you a complete listing, and I'm going to also point out the most common distribution codes that you should really know. Just offhand, off the top of my head, the most common distribution codes that I see are code G, code 1, code 2, code 3, code 4, and code 7. So those are codes you definitely should learn, and you'll see any one of these commonly enough that it should really become, it shouldn't take you that long to learn them, but until you've learned them, the meanings of the codes are always spelled out on the 1099-R instructions. They're not hard to find. Next, we have the IRA Simple SEP box. If this box is checked, it means that the money came from an IRA or a SEP or Simple plan. And if that box is checked, the relevance of it is that you may need to complete Form 8606. Also, it tells you that this client may have other additional special tax treatments that could apply. And finally, if that box is checked, the pension income is reported on line 16A, but if the box is checked, line 15A is where you would report income from an IRA. So what I'm saying here is if the IRA box is checked and you had a $10,000 distribution, that distribution would end up being reported on line 15B of the 1040. And if the IRA box is not checked, just get rid of it, then you would end up reporting that pension income on line 16B. Looking at the other boxes here, you will see that there is a place to have state tax withheld. And if you live in a state that has state income tax, there's usually a number in that box because it would be normal to pay tax to the federal and at the state level on pension income. Now, I'm not going to read you all of the line descriptions in the course manual. I will leave you to do that on your own time since I have taken the time to explain them visually in front of you. So let's just move down until we get to the definitions for the codes that go in box 7. And so that's really the distribution codes begin at the bottom of page 3 of your manual. And I will read through this section a little bit. The code that appears in box 7 indicates the type of distribution that has been made. And included in this manual is a list of the various codes and their meanings for 2010. You should also refer to pages 12 and 13 of the instructions for Forms 1099-R and 5498 for more details. But let's look at the penalty descriptions, and the first one is code 1. Remember, code 1 is one of the codes I told you that you should know. If you have a code 1, that refers to an early distribution from the retirement account with no known exception to the early withdrawal penalty. If you have a code 1, then typically what it means is that over on the 1040 form, you are going to need to enter a penalty on line 58. You'll see line 58 says additional tax on IRAs, other qualified retirement plans, etc. Attach Form 5329 if it is required. So if you have an early distribution penalty that does apply, that distribution penalty is entered on line 58, and the penalty is typically 10%. So in that 1099-R that I showed you a moment ago, I showed you that there was a distribution of $10,000 and that the taxable portion of that was $9,000. And if they had a distribution code of 1 that subjected them to a penalty, then what it means is that the penalty that would need to get entered on line 58 is $900. So $900 is a pretty significant additional tax that would need to be paid in that type of situation. The next code to be aware of is code 2, early distribution, but an exception applies. It means that the distribution is typically going to be considered taxable, but it won't be subjected to the penalty. The most common reason I see a distribution code of 2 is when a person does a rollover from a retirement account, such as a pension plan at work or a traditional IRA, into a Roth IRA. That is the most common reason I see a distribution code of 2, but there are other reasons you might see that code as well. Distribution code 3 refers to disability. Even though you are under the minimum retirement age, it is possible to take a distribution and not have to pay the early withdrawal penalty if the reason you did so was because you became disabled. And if you qualify, they should check that box, or not check that box, but enter code 3 in box 7. The next one is death benefit, number 4. If you have a code 4 in box 7 of your 1099-R, it means that you have inherited this pension plan or IRA amount, and it is taxable to you as income, but it would not be subjected to a penalty. Then there's a whole bunch of other additional codes. I am not going to read them all to you. Clearly, if you have a 1099-R that comes to you and it has any of these codes on it, it would be your responsibility to go read the instructions and determine what you are supposed to do because that code appears. But I will show you here code G because that is one of the codes that I said is fairly common. Code G will appear on a 1099-R if you are doing a rollover from your pension plan or your IRA to another pension plan or IRA. And a direct rollover is typically not taxable. There's also a code H you see here, which is a direct rollover from one Roth IRA account to another Roth IRA account, and that typically would not generate a penalty. Code J refers to early distributions from a Roth IRA with no known exception. One of the key things to remember about Roth IRAs is that when you make a contribution to a Roth IRA, you are never allowed to take a deduction for it. So it is virtually always the case that you have a cost basis in your Roth IRA, and therefore you should be very careful. If you have a client who comes into you and they have a 1099-R and it shows that they had a Roth IRA distribution with a code J, you should be thinking, okay, they're taking this distribution early and there could be tax consequences here, but it does not mean that all of the distribution is taxable because it's going to be your job to figure out what their cost basis is and do an 8606. That is Form 8606 to determine how much of the distribution is taxable and whether an early withdrawal penalty applies. Now, distribution code L is the next one I want to talk to you about. This is a code that I don't see horribly often, but it comes up sometimes. And it happens when a person decides to go to their plan administrator and take a loan against their pension plan. And typically the reason people do that, or a qualifying reason why they are allowed to do that, is for purchase of a home. So if you borrow money from your pension plan to purchase your home, it's a pretty good deal. It's typically an interest-free loan, and there's no tax consequence to having taken that money out. And if you repay the money back in, you've basically had a down payment or money for purchasing your house available to you with no real tax consequence. However, it does happen sometimes that after a person borrows money from their pension plan, they fail to make a repayment. They may fail to make repayments because they just didn't have the money to do so, or it could be that they got laid off or quit or retired from that employer. Any of those reasons might cause that employer's plan administrator to treat that loan as a distribution. And if you have a loan that is treated as a distribution, code L will appear on the document. And it can be confusing to the client because the client may say, well, I never took money out of my plan. I don't know why I got that. And it would be because they took money out a while ago. Could be years ago that they took money out. But now is the point where they're going to have to recover that income and pay tax on it. And code L can be subject to an early withdrawal penalty as well. Now moving down, the next one I wanted to point out to you is code S. And that has to do with an early distribution from a simple IRA plan in the first 2 years. If a code S appears in box 7, your client is in big trouble because instead of paying the usual 10% penalty on the early distribution, the penalty goes to 25%. So remember, we said we had a $900 penalty on $9,000. Imagine taking that and making it 2.5 times that amount. That's a big penalty. All right, and there's just a little box right here. It says that you should memorize the meanings of codes 1, 2, 4, and 7 because they're the codes most commonly seen. Absolutely, I would say those are the 4 most common codes, but I would bear in mind code L and code G pop up regularly as well. Moving on down, the next form I'm going to show you is Form 5498. This is kind of an oddball form. It's been around for a few years now, but it wasn't always around. I've been in the tax business doing tax returns much longer than this form has existed for. Thinking back, I believe the IRS first introduced this form maybe 5 or 6 years ago was the first time I saw it. And the reason the form came out is that IRS wanted to have access to information about people's IRAs so that when they are reporting IRAs on their tax return, the tax filer has information available to them about the contributions they made to the IRAs over time and that they know the fair market value of their plans at the end of the year. And the information that appears on this document is provided to the taxpayer and it is provided to the IRS, but this is not a document that you attach to the tax return. It is a document you use to make certain calculations, typically Form 8606, and also whether or not your client may possibly be allowed to take a deduction for a contribution that they made to their plan. So let's just take a look at it real quick for a minute. You'll see that box 1 shows the amount of money or contribution that was put into an IRA for the year. Box 2 shows rollover contributions. That means money that came into the plan but through a rollover to the plan from another plan. There's also a Roth IRA conversion amount, and that has to do with converting money into the plan from an IRA. So you have a regular IRA and you're converting it into a Roth IRA. That's what box 3 is for. You can also have a recharacterized contribution, which means you had it in a Roth, and now you're recharacterizing it and putting it back into a traditional, just money going back and forth between these two types of IRAs. Box 5 shows the fair market value of the account, and that is important when you are filling out Form 8606. Line 7, we show the type of IRA that the form relates to. So Form 5498 refers to IRA accounts only, but there are a number of different IRA types. And the first box to check is IRA, which simply means the original IRA, which is now referred to as a traditional IRA. There's also SEP IRA, Simple IRA, and Roth IRA. And which of these boxes is checked is going to tell you what type of IRA the form relates to. We also have a box 8 where we show SEP contributions. Box 9 is where we show simple contributions. Box 10 is where we show direct IRA contributions to a Roth account as opposed to a conversion to a Roth account from an IRA or a pension plan. And then, of course, the other boxes, I'll just leave you to read those on your own time. Now, all in all, Form 5498 is submitted to the IRS by the custodian of your individual retirement arrangement to report contributions, including rollover contributions, Roth IRA conversion amounts, recharacterized contributions, and the fair market value of your account. All of that information is useful in preparing your client's tax return, and the information can be used by the IRS to help establish basis and determine whether or not tax deductions may be allowed in a year of a contribution. Now, Form 5498 is a reporting document only. It is used for reporting contributions, including simple SEP and Roth IRAs. It also shows amounts that may or may not be reportable on your tax return. Remember not to attach Form 5498 to your tax return. Keep it for your records. And for more information about the form itself and other instructions relating to IRAs, please read IRS Publication 590 and 560, and then the instructions for Form 1099R and 5498. All of those documents are available inside the Forms and Publications tab of the LMS. We're getting on now to a topic that I really don't even like teaching it because it's almost a waste of my time as your instructor to teach it and a waste of your time as a student to learn it. However, as long as it remains law, I feel an obligation to make you aware of this particular concept. There's always the possibility you will get tested on it, and there's also the very remote possibility you might actually end up with one in front of you. So we cover it until IRS basically removes it and says, or says that it's no longer of relevance. I feel I need to continue teaching it. A lump sum distribution is the distribution or payment of a plan participant's entire balance within a single tax year from his or her employer's qualified plan. This rule does not require the employee to take a complete distribution from all plans they hold at one time, but rather the entire balance within any one plan with a particular employer. And examples include pension, profit sharing, and stock bonus plans. I'm going to only cover this first paragraph and leave everything else on this topic for you to read on your own time. But this first paragraph right here will help you identify whether or not you have a client that will be affected by a lump sum distribution rule. The lump sum distribution rule is only relevant if your distribution included your entire balance from all of an employer's qualified pension plans of one kind, and none of the distribution was rolled over, and you were born before 1936 and participated in your company's plan for at least 5 years before the year of distribution, and you have not used Form 4972 after 1986 for a distribution on your own plan, and you are receiving the distribution as a beneficiary of a plan participant who was born before 1936, who died, and you have not used Form 4972 after 1986 for a previous distribution from that plan participant. So you can see that we're looking at a very narrow segment of society, not that many people left around that were born before 1936 who are retiring at this point in time and could take a lump sum distribution. But it is possible that you could have someone who has died and their beneficiary is taking all of the money from that plan as a lump sum distribution, and they could qualify in certain situations for special tax treatment. So if they do qualify for special tax treatment, the form that is used to claim that special tax treatment is Form 4972. There are instructions on the next 2 pages about that form and the purpose of it, and the main benefits that apply fall under capital gain treatment rules and the 10-year tax option rule. I am going to move on to the more important topic of the day, though, which is Form 8606. If you withdrew money from a traditional IRA in which you have a cost basis, you use Form 8606 to report the amount of the distribution and to calculate the taxable portion of the distribution. If you do not have a cost basis in your IRA because all your contributions to the IRA were fully deducted on your prior year tax returns, then your entire distribution from your traditional IRA is taxable and you do not need to complete Form 8606. So there are really 2 key reasons why you fill out Form 8606. You fill out Form 8606 because you made a non-deductible contribution to your IRA, and you fill out Form 8606 because you are taking a taxable or partially taxable distribution from your IRA in which you have a cost basis. Now, Form 8606 is required in all of the following situations. Number 1, you made non-deductible contributions to a traditional IRA for 2010, including a repayment of a qualified reservist distribution. You received distributions from a traditional SEP or simple IRA in 2010, and your basis in your traditional IRA is more than 0. You converted an amount from a traditional SEP or simple IRA to a Roth IRA in 2010. You rolled over an amount from a qualified retirement plan other than a designated Roth IRA to a Roth IRA in 2010. You received distributions from a Roth IRA in 2010. You rolled over an amount from your 401k or 403b plan to a designated Roth account within the same plan, called an in-plan Roth rollover, after September 27, 2010. Or you received a distribution from your designated Roth account after September 27, 2010 that is allocable to an in-plan Roth rollover. Or you made a repayment of a qualified disaster recovery assistance or qualified recovery assistance distribution that is attributable to previously non-deductible contributions. Or you received a distribution from an inherited IRA that was not a qualified distribution or a traditional IRA that has a basis, or you rolled over an inherited plan account to a Roth IRA. So that's quite a mouthful. The bottom line behind all of it is that anytime you put money into an IRA or take a distribution from an IRA or have a Roth rollover from an IRA, you're probably going to need to be thinking about this form. So we're going to spend some time learning about how the form works. And as I said at the beginning, Form 8606 is used for two key purposes. One is to put money into your IRA that is not deductible, and the other is when you take a partially taxable distribution from your IRA. Today we're going to talk about how to calculate a taxable distribution from an IRA. And in session 6, we're going to look about how to put money into an IRA and calculate what your deduction for it is. So we're going to be touching on 8606 in today's class, and in session 6 we're going to touch on it again, but in a different way. So here is the form, and you can see that the form is divided up into multiple parts. Part 1 is where you calculate the portion of a distribution that is taxable. It is also used to notify the IRS if you are making a partially non-deductible or fully non-deductible contribution. Part 2 of the form is used when you do a conversion from a traditional SEP or simple IRA to a Roth IRA in 2010. It's a special rule that applies to 2010 only, and Part 2 continues right here. Part 3 is used to report a rollover from a qualified pension or other retirement plan to a Roth IRA. So Part 2 is used to show a conversion from a traditional or SEP or simple IRA to a Roth, and Part 3 is used to show a rollover from another type of retirement plan to a Roth. And then Part 5 is used to show distributions from Roth IRAs and to calculate the portion of a distribution from a Roth IRA that is taxable. So to show you how Form 8606 to help you better understand how 8606 works, we've created an illustration for you, and as an added special bonus, this illustration also includes some Social Security income so that we have another opportunity to show you how to calculate the taxable portion of a Social Security benefit received. The illustration involves a character named Andy Lusion. He is single and retired, and he has $12,000 of interest income and received the following retirement income statements for the year. His total basis in his traditional IRA is $150,000. Prepare his Form 8606 and the Social Security Benefits Worksheet. So let's take a look at the first 1099-R here. You can see we have two different companies that have similar names. We have Savers Investment Group and we have All Savers Investments. They have different EINs and they are different companies. The first one, Savers Investment Group, has issued a 1099-R showing a gross distribution of $24,000. Box 2A, taxable amount, is blank, and the taxable amount not determined box is checked. We can see that it's a normal distribution, not subject to any kind of penalty, and that the distribution comes from an IRA because the IRA box is checked, and there was federal withholdings of $2,400. On All Savers Investments, the boxes look fairly similar. We see a distribution amount of just $12,000, however. And then moving on to the next page of this problem, we have the 5498s for each of these accounts. Now, in the first IRA account, Savers Investment, there were no contributions made during the year. There's just a fair market value of the account at the end of the year of $250,000. And on the second account, we also have no distributions being made. We just have a fair market value at the end of the year, and it too is an IRA account. So what do we know right now? We know at the end of the year we had combined IRA values of $350,000 because 100 plus 250 is 350, and we know that the cost basis in those accounts is $150,000 because we've told you that right here at the top of the problem. The next piece of information relating to this problem is the Social Security Benefits Statement, Form SSA 1099. And it shows that our recipient had $18,000 of Social Security benefits for the year, and $1,800 of federal tax was withheld as well. Over here in box 3, we threw in a number and called it Medicare Part B. That's actually quite a common thing to see. Many people who are receiving Social Security are also qualifying for Medicare, and if the income is high enough, they are required to pay into Medicare. And so for this person who is receiving Andalusian, he had to pay in $1,090 to Medicare Part B. That, incidentally, is deductible to him as a medical expense on Schedule A. And we'll discuss how to claim medical expenses later in our course. So let's take a look at what Andalusian's finished 8606 would look like. And we begin on line 2 by entering his cost basis in his IRAs, which is $150,000. If he had made contributions during the year, those would be entered on line 1, but he did not make contributions during the year. He only took distributions. Line 6, we enter the fair market value of those plans at the end of the year, and we got that number from the Forms 5498. That's why it's important to have those handy. And we then look at the amount that was distributed for the year. We have two 1099-Rs, one for $24,000, one for $12,000, and when you combine those numbers, you get $36,000. We then take 36 and add that to 386, because if at the end of the year he had $350,000 left in his IRAs, then it means at some point in the year he must have had closer to $386,000 in the accounts, right? So they take those two numbers and add them together. It's not an exact science, the thinking there, but it is part of the formula that is used. And then what we do is we take line 5, right up here, that $150,000, and divide that by line 9, and we get a ratio or a percentage, which is 0.3886. That 3.886 is then multiplied by the number on line 7 to give us the non-taxable portion of the distribution. So this portion here, the $13,990, is the amount of the distribution that is not taxable. And the difference between this number and the amount he took as a distribution on line 7 is the taxable amount. So on line 15, we have the taxable amount, and that will carry to the Form 1040 form. Just scroll up here to page 1 of Form 1040. It is an IRA distribution, so we would enter $22,010 on line 15B, and we would enter $36,000 on line 15A. And the $150,000 cost basis and the $350,000 fair market value, those don't appear anywhere on the 1040, but they are numbers that are entered on the Form 8606 for purposes of calculating the non-taxable and taxable portions of those distributions. So the next part of this problem is to complete the Social Security benefits worksheet for Andalusian. And I wanted to just draw your attention to some numbers that have been entered on here. The first number is 18,000, and we got that number from box 5 of the Social Security benefits worksheet. Step 1 of the worksheet is to take your Social Security benefits and divide them in half, and when we do that, we get $9,000. Step 2 is to look at all of the other income that Andalusian had for the year. And remember, we have just finished calculating that the taxable portion of his distribution from his IRA is $22,010. We did that on Form 8606. And then we add to that the $12,000 of interest income he received. So $22,010 plus $12,000, that gives us $34,010. We add $34,010 to $9,000, and we get $43,010. We now look to the base amount for a single person, and that's $25,000. So we enter $25,000 on line 9 and subtract it from $43,010, and we get this number, $18,010. Now, the most portion, or the largest portion of his Social Security benefits that could be taxable is 85% of $18,000. We're going to see if maybe he will need to pay less than 85% of, or pay tax on less than 85% of $18,000. So we continue with the worksheet and continue with our calculations. Step 1 is to take the difference between the base amount and the amount on line 8. And when we do that, we get $18,010. We then look to another number, which is $9,000. It's just another number that is a part of the formula for determining the taxability of Social Security benefits. And if the number on line 10 is less than the number on line 11, then you would simply take the number on line 10 and ultimately divide it in half, and that is the taxable portion of the benefits. But the number is more on line 10 than it is on line 11, so we're not done. And the next instruction is to take line 10, subtract line 11, and enter the total on line 12. We then enter the smaller of line 11 or 12 on line 13, and that is, of course, $9,000. They're almost equal, but there is a $10 difference, $9,000 being the lower number. And now the worksheet says divide line 13 in 2 and enter the total. That's $4,500. Then it says take the amount on line 12, that's that 9,010 number, and multiply it by 85%. And when you do that, you get 7659. Now, none of this may seem terribly logical, but the next step in the worksheet is to take the 4,500 and add it to 7659 and enter that number on line 17. And when you do that, you get $12,159. The final step is to take 18,000, multiply that by 85%, and when you do that, you get $15,300, and you enter that on line 18. And the final step is to take the lesser of these two calculations, 85% of line 1, or the number that you calculated and entered on line 17. And of course, the number on line 17 is the lesser of the two numbers, so this is the amount that's going to carry to the 1040 form. So just thinking in our minds, what are we going to do with Andalusian's return? Well, we're going to enter 36,000 on line 15A. We're going to enter 22,010 on line 15B. We're going to enter $12,000 of interest income on line 8A. Then on line 20, we're going to enter $18,000 of Social Security benefits received. And on line 20B, we're going to enter $12,159 as the taxable portion of those benefits. And to just show you what that finished tax return looks like, we've slapped it in here for you. There's the interest income. There's the gross pension distribution, or actually IRA distribution rather. There's the taxable portion of the IRA. There's the gross Social Security. There's the taxable portion of the Social Security. And here is Andalusian's adjusted gross income. He is age 65 or older, so he does get a larger standard deduction than your average single person. So we're going to enter $7,100. That's includes the additional amount for being age 65 or older, and we did check the box. He's got his personal exemption amount and taxable income of $35,419. We look up the tax on that from the tax tables and get $5,038. He had $5,400 withheld on his annuity, or not annuity, but his IRA statements, and so he ends up with a $362 refund. So that concludes the illustration on Andalusian. The next part of today's class is to discuss rollovers. And this would be a good point to give you a password, and an excellent point for you to take a break if you feel like you need one right now. The next password I'm going to give you today is the password to unlock the Session 4 homework answer key. And that password is Auckland, A-U-C-K-L-A-N-D. Auckland is the largest city in the country of New Zealand. So if you'd like to take a break at this point, you can do so. I'm going to continue on now with the lecture. And the topic that we're picking up with here is rollovers. If you withdrew cash or other assets from your qualified pension plan or IRA, you can defer tax on the distribution by rolling the funds over into another qualified plan or IRA. You have 60 days to roll the taxable portion of your distribution into another qualified plan or IRA. You can choose the direct rollover option by having the administrator of your old plan transfer the distribution directly to the new plan or IRA. And if you had that done, then box 7 on the 1099-R should have a distribution code of G, G being direct rollover from one plan to another. So just remind you that code G is the code that you would look for in the event you were dealing with a rollover. 3, if you choose to withdraw your taxable portion without rolling it over to a new plan, the plan administrator must withhold 20% income tax from the distribution. So let's just suppose you have a 1099-R and you have $100,000 showing as a distribution, and it is an early distribution. Then your plan administrator should be withholding 20% or $20,000 on that $100,000 distribution. You do have 60 days to roll the money over, but you would have to roll over all $100,000 even though the plan administrator held out $20,000. So you're going to have $80,000 cash when you're supposed to roll over $100,000 cash. That's why it makes sense to go for the direct rollover option. Under the direct rollover option, the plan administrator does not need to do any withholding. Rollovers to Roth IRAs. You can convert amounts from either a traditional SEP or simple IRA to a Roth IRA. These conversions are treated as a rollover regardless of the conversion method used. You may also roll over eligible distributions from a qualified retirement plan to a Roth IRA. But prior to 2008, rollovers could be made only to a Roth IRA from a traditional SEP or simple IRA. And then beginning in tax year 2008, it is now possible to roll over to a Roth IRA all or part of an eligible distribution you received from your from you or your deceased spouse's qualified pension plan, profit sharing or stock bonus plan, 401k plan, annuity plan, tax shelter annuity under 403B, and deferred compensation plans of the state or local government. So the rollover, though, is subject to the same rules that apply for converting a traditional IRA to a Roth IRA. But there is a House Rule 4297, Section 512, that was enacted in May of 2006, and it did end the AGI and filing status requirements on traditional IRA conversions to Roth IRAs. So therefore, as of January 1, 2010, the modified AGI and filing status requirements for converting a traditional IRA or rolling over an employer plan to a Roth IRA are eliminated. So that's another mouthful. What it is essentially saying is it used to be the case that you could only do a rollover to a Roth account from a traditional IRA if your income was below a certain amount of money. And beginning in 2008, that threshold or that maximum income amount was removed, and now it does not matter how much you earn, you're still allowed to do the rollover from a traditional IRA to a Roth IRA, and the rules have now been expanded so much that it is possible to do a rollover to a Roth IRA from any kind of pension plan, essentially. Now, prior to 2010, taxpayers with a modified adjusted gross income of over $100,000 and or a filing status of married filing separate were not allowed to convert traditional IRAs to a Roth IRA. Now, you should note that a rollover to a Roth IRA is not tax-free. So if you take money from a traditional IRA and roll it over to another traditional IRA, or if you roll money from a pension plan over to an IRA, that does not create a tax consequence. Remember, we have that 1099-R that has a code G. It's rolled over. None of it's taxable. But if you roll over from any kind of pension plan to a Roth IRA, that is not a tax-free event. And I probably should explain why. Now, one of the things I can tell you after all my years in this business is that investment advisors love Roth IRAs. They just think they're the greatest things in the world. And the way a Roth IRA works is you open up a Roth IRA and you put money into it. And over your lifetime, if you start investing at it at a fairly young age, you could imagine you could build up quite a bit of money in that plan. If you were, investing a few $100s every month for 30 years, you could put a lot of money in there. And while the money is in the Roth IRA, it grows tax-free. And if, when you retire and start taking money from that plan at age 59.5 or later, you can take money from your Roth IRA and it's tax-free. That's why investment advisors love Roth IRAs, because you put the money in there, it earns income, and you never have to pay tax on it in most situations. Compare that with another kind of pension plan or the traditional IRA. With a traditional IRA or a regular type of pension plan, the money you put in there grows tax-free while it's in there, but when you start to take money out, it's fully taxable. So what's the difference between how a traditional IRA works and how a Roth IRA works? And why is it that when you put money into a Roth IRA, you can later take it out and not pay tax on it? But when you put it into a traditional IRA and then take it out, it is taxable. Well, the difference is that when you put money into a Roth IRA, you're not allowed to claim any kind of tax benefit because you did so. There's no deduction, there's no salary deferral, no nothing. It's like putting money in a savings account. So what it means is that when you invest in a Roth IRA, you are always doing so with after-tax dollars. So if you have money in a traditional IRA, then by now you should understand that when you make contributions to a traditional IRA or to a traditional type of pension plan, you do not have a full cost basis in that plan. In fact, you may have no cost basis at all, and that when you start taking money from that plan, it is taxable. So if what you do is have a plan with no cost basis that you then roll over into a plan that has a cost basis, such as a Roth, to get a cost basis in that Roth, you're going to have to report the rollover in your income. So that's why we say that a rollover into a Roth IRA is not tax-free, and you must report the rollover distribution on your Form 1040. Now, if the rollover was from an IRA, enter the rollover distribution amount on Form 1040, line 15A, right here. And if you have a tax basis in your IRA, you will need to complete Form 8606 to figure the taxable portion of your rollover. Enter the taxable portion of the rollover on line 15B. If the rollover was from a pension plan or annuity, enter the total distribution you received from your qualified pension plan that was rolled over to the Roth IRA on Form 1040, line 16A. And then enter the taxable amount on line 16B. There is also something called an in-plan direct rollover from a 401k and 403b plan to a designated Roth account. Section 2112 of the Small Business Jobs Act allows participants to make in-plan rollovers from their 401k and 403b plans to their designated Roth accounts. These are called in-plan Roth rollovers. They are allowed after September 27, 2010. The taxable amount rolled over is includable in income equally in 2011 and 2012 unless the taxpayer elects to include it in income for 2010. Well, this is a special thing that is occurring for 2010 only. If you prepare tax returns for the first time in 2012, then in 2012 you will be preparing 2011 tax returns. And on that 2011 tax return, you may be reporting income from a rollover that occurred in 2010. Because if you did a rollover to a Roth in 2010, you're allowed to not report the income in 2010 and instead report it in 2011 and 2012 in equal portions. So it's kind of a freebie for 2010, but then you include it in equal amounts in each of 2011 and 2012. So lots of investment advisors got really excited about being able to do these rollovers in 2010, but defer paying tax on them until 2011 and 2012. So we saw quite a few of these coming into our office. Now, because this is a course on 2010 tax law, we're going to be showing you what happens on the 2010 tax return. But you should be thinking ahead to 2012 when you are preparing 2011 tax returns so that you understand what will happen in the next year. So you report the rollover in Part 3 of Form 8606. Your plan must provide a written explanation of the consequences of making an in-plan Roth rollover. In-plan rollovers cannot be undone. Unlike rollovers to Roth IRAs, you cannot later recharacterize an in-plan Roth rollover. Early withdrawal penalty does not apply to rollovers. In addition, the additional tax or early withdrawal penalty under Section 72T does not apply to rollovers from Roth IRAs. Rollovers to Roth IRAs, rather. Rollovers from IRAs, 401ks, and 403bs should be reported on Form 1099-R with the amount rolled over in Box 1, that's the gross distribution, the taxable amount showing in Box 2A, and any basis in the rollover showing in Box 5. You use then Code G in Box 7 of Form 1099-R or Code 2. I see that equally as often, frankly. and the mandatory 20% withholding does not apply to the in-plan Roth direct rollover. So let's look at some special rules for 2010 conversions and rollovers. For any 2010 conversion or rollover from an IRA or employer plan other than a Roth IRA to another Roth IRA, any amounts that would be included as income will be included in equal amounts in 2011 and 2012 instead of in 2010. A taxpayer can elect to include the entire rollover amount in his or her income in 2010 instead of deferring it to 2011 and 2012. The election to do so is made on Form 8606 on line 19 of the form. If you elect to defer the taxable part of a 2010 conversion over the 2-year period, that is 2011 and 2012, and then in 2010 you take a distribution of any of the amount allocable to the taxable part of the conversion, then the following rules apply. So what is this saying? I'm confused already just reading it to you, even though I wrote it. So what's happening here is that in 2010, if you do a rollover from a traditional IRA to a Roth IRA, for example, you don't need to include the income in 2010. Instead, you're going to include it in 2011 and 2012. But let's just suppose that after you rolled the money from your traditional IRA to your Roth IRA, you then took the money out or distributed money from the Roth. IRS is saying, but wait, there's no freebie there. You're not going to defer tax on that distribution from the Roth because you rolled it from the traditional first. And so you are going to have some tax consequences associated with that. The taxable part of the conversion that is distributed in 2010 must still generally be included in the 2010 income and cannot be deferred to 2011 and 2012. Also, the amount included in income in 2010 will reduce the amount includable in income for 2011 and 2012. You reduce the amount included in income for 2012 first, and then the amount to be included in 2011 in income second. And we have a pretty detailed illustration of how to do this fairly complex calculation in our 1040 CPE series on pension income. Our basic tax course, we don't go into that illustration because it's far too complex, but later on, if when you're looking for continuing education, you want to see how that illustration might flow through or follow out, we do have that in our CPE course on pensions. But what we do have here for you is an illustration of doing a conversion to a Roth IRA from a traditional IRA and how that would play out on Form 8606. So here we have an illustration. In 2010, Jenny rolled over $10,000 from her traditional IRA to her Roth IRA. This is Jenny's only IRA. She has no basis in her traditional IRA, so the rollover is taxable to her. She received the illustrated 1099-R, gross distribution 10, taxable amount 10. They're showing a distribution code of G, and it is an IRA that is for an IRA that she took it from. So Jenny can report the rollover in either of the following ways. Option number 1 is to report no income for 2010 by completing Part 2 of Form 8606. So here we have Part 2, and on line 16 we show the amount that was converted from the traditional IRA to the Roth IRA, and we show the portion of that conversion that is taxable on line 18. All of it's taxable because she has no basis. Then on line 20A, we show the amount that she will include in income on her 2011 tax return. And on line 20B, we show the amount she will report in her income on her 2012 tax return. Option number 2 works differently. In option number 2, Jenny decides that she's not going to defer the income at all. She would rather include it in an income on her 2010 tax return. So if she does that, she fills out Part 2 and shows the taxable portion of the distribution. But instead of putting numbers on line 20A and 20B, instead on line 19 she reports that she's electing to include all of that income on her 2010 return. So she'll carry that amount, $10,000, to line 15B of her 2010 return, and she would make no entry for that income in 2011 or 2012. So there's basically two ways Jenny can handle it. One is to spread the income over 2 years. She can include it in an income $5,000 each in 2011 and 2012, or she can report all of the income in 2010. Of course, she wouldn't do both. I already touched on loans from pension plans when I was describing distribution code L to you. You may be able to borrow money from your qualified pension or annuity plan, tax-sheltered annuity program, government plan, or contract purchased under any of these plans for purchase of a first home. If you close out of the plan prior to paying back the loan, or if you default on paying back the loan shall be considered a distribution, and you may have to include in income all or part of the amount borrowed unless certain exceptions apply. Now, one of the things I have shown you a little bit earlier in today's class is that there is something called an early distribution tax or additional tax on IRAs. We often refer to that as the early withdrawal penalty, and that tax is paid on line 58. The next part of today's class is going to be focusing on when that penalty applies and how you calculate it, as well as exceptions to the penalty and when an exception applies. Pension plans and IRAs are given special tax treatment to encourage people to save for their retirement. Penalties exist in the form of additional taxes if the funds within a plan are withdrawn early, these are called early distributions, or the minimum required amount is not distributed, that means not receiving the minimum distribution. Tax on early distributions. The early distribution penalties apply in the following situations. Number one, you will generally be required to pay an additional 10% on your early withdrawal from your qualified retirement plan, IRA, or annuity if you withdraw funds before you reach age 59 and a half. The tax applies to the taxable part of the distribution. There is a 25% additional tax for early withdrawals from simple IRA plans if the distribution occurs within the first 2 years of participation in the plan. Your Form 1099-R should show a code S in Box 7 if you are required to pay this tax. Now there is another kind of penalty, a 5% additional penalty on certain early distributions from deferred annuity contracts. You should note that the tax on early distributions is commonly referred to as the early withdrawal penalty. So if you hear me say early withdrawal penalty, you should be thinking of that additional 10% tax. How to report an early distribution from an IRA, pension, or annuity. Report a taxable distribution from your IRA on Form 1040, line 15B, and report a distribution from your pension plan or annuity on line 16B. If you are under age 59 and a half at the time of the distribution, you will be required to pay a 10% tax unless you qualify for one of the exceptions discussed next. If you do not qualify for one of the exceptions to the penalty, enter the penalty amount on Form 1040, line 58. Now, in general, you can assume that there is a penalty if a person takes a distribution before their age 59 and a half. But you should not assume that there will always be a penalty without first considering that there may be an exception to the penalty that your client qualifies for. And because the penalty can be so severe in terms of tax dollars, you take $10,000 from a pension plan, the penalty is 10%, that's a $1,000 early distribution tax that you have to pay. So as a tax preparer, it's your job to really be on top of the exceptions to the early withdrawal penalty, because when your clients come to you, if you interview them well, you may discover that they qualify for an exception to the penalty, and you could save them a boatload of money. So we're going to go through some of the exceptions to the penalty, and it's your job as a preparer to learn them. There are a number of different situations in which the tax for an early distribution does not apply. Following are examples of situations that qualify as exceptions to the additional tax. And here they are. Payments made as part of a series of substantially equal periodic payments made at least once each year for your life or life expectancy, or the joint lives or life expectancy of you and your beneficiary. If the qualified plan is not an IRA, you must have separated from servicing your employer. So what that's saying is you retired, you're under age 59.5, but you have retired and you're now taking distributions as if you were retired. They're equal in that they're the same amount each month or each year, and they're staggered such that the payments from the plan will last for your lifetime. That would be an exception to the penalty. Another reason that you may not have to pay the penalty is because you took the distribution because you were totally and permanently disabled. Now, when you do take a distribution because of disability, there should be a code 3 in box 7, but even if there is not a code in box 7, a code 3 in box 7, you could still qualify for an exception if you are in fact disabled. Payments made to a beneficiary on or after the date of death of the plan participant or contract holder. So essentially, the participant has died, you are the beneficiary, and now you're taking money from the plan. That would be a reason why you are not required to pay the penalty. In that case, there should be a code 4 in box 7 of the 1099-R, but if there is not a code 4 and there's a code 1 instead, for example, and you know that you are receiving it as a beneficiary of a person who died, then you would be able to qualify for an exception to the penalty by attaching Form 5329 to your return. Another reason is that the payments were made from a qualified retirement plan other than an IRA after you separated from service in or after the year you reach age 55. So even though the minimum age is 59.5, it may be that you work for an employer where you retired at age 55. And if you are a public safety officer, such as a police officer or firefighter, that retirement age or minimum retirement age is age 50. And under those circumstances, you can start to take distributions before you reach age 59.5. Also, another reason to not pay the penalty would be because the payments were made from a qualified retirement plan other than an IRA to an alternate payee under a qualified domestic relations order. What does that mean? It means that the spouse got it all in the divorce, and you've had to empty out your retirement plan and give it all to your spouse as a part of the divorce. And if that is the reason for the distribution, then you don't have to pay the penalty. Payments made from a qualified retirement plan to the extent you have medical expenses in excess of 7.5% of your adjusted gross income. So if you have a lot of medical expenses for the year that you are itemizing and claiming a deduction for on Schedule A, or even if you don't have enough to itemize on Schedule A, but the medical expenses still exceed 7.5% of your income, then to the extent that your expenses exceed 7.5% of your income, you do not owe a penalty. Or payments made from an employee stock ownership plan for dividends on employer securities held by the plan. And finally, payments made from a qualified retirement plan due to an IRS levy of the plan. So essentially, the final one, what's that about? Let's just suppose you owe the IRS a bunch of money and you haven't been paying it. So finally, they just levy your plan and pull money out of your pension plan to collect the taxes you owe to them. They're not going to make you pay the 10% penalty if they do that. Isn't that nice of them? Okay, now, these are the major exceptions that apply to both IRAs and pension plans and annuities. But there are additional exceptions to the early withdrawal penalty, but these apply to IRAs only. And one of the things that we will do with our quiz questions, and could certainly happen at the IRS level with the IRS exams, is they're going to be pinpointing, and we will certainly be pinpointing, whether or not you have it in your head that this penalty exception applies to an IRA or to a pension plan or to both. And there are a number of really wonderful exceptions to the penalty that apply to IRAs only. So you have to be on your guard that, if a person took an early distribution from a pension plan and then used the money, say, for higher education expenses, that because it came from a pension plan, it would not be an exception to the early withdrawal penalty. But if they had taken it from an IRA, it would be an exception. So what's the advice to that? Well, if you have a person or a client who needs to take money from their pension plan to use for a particular purpose, and that purpose is a purpose that would qualify for an exception for IRAs but does not qualify for one from pension plans, then what they should do is roll the money from the pension plan into the IRA and then take the money out of the IRA. So let's see what these additional IRA-only exceptions are. The first one is to the extent of medical insurance premiums you paid while you were unemployed. So if you paid for health insurance after you lost your job and you were unemployed, then to the extent that you paid for health insurance, the amount that you paid or to the extent of your higher education expenses that you paid through cash or loans for yourself, spouse, your children, or your grandchildren. So let's just say you pulled money from your IRA to pay for your kids to go to college or for you to go to college. You wouldn't have to pay a penalty on the portion that was actually used to pay for college. And finally, up to $10,000 can be withdrawn penalty-free for first-time home purchase for yourself, your spouse, your children, your grandchildren, or your ancestors, provided the home purchase occurs within 120 days of the distribution. So let's just suppose you're trying to come up with the money for the down payment on your first home. So you go to your IRA account and you pull out $10,000. You can use that $10,000 as a down payment on the home, and you will not need to pay a penalty on it. Now, I do have to caution you that there's a very big difference between taking money tax-free and taking money penalty-free. You're not going to be able to withdraw money tax-free from your IRA. You're going to be able to withdraw it penalty-free from your IRA if you meet one of these exceptions. So how do you claim an exception to the early distribution tax? If you qualify for one of the exceptions listed above, you must complete Form 5329 Part 1 to claim the exception. You do not need to complete Form 5329 if you do not qualify for an exception to the penalty. So completing Form 5329, in Part 1, you enter the amount of the early distribution on line 1. Then you enter the amount of early distribution that qualifies for an exception to the tax on line 2. And in the space provided next to line 2, you enter the appropriate exception code from the following list. So here is a list of all of the reasons why you would not have to pay the penalty. And you can see they fairly much go in the same order of what I've just described to you. You would use exception code 1 if your qualified retirement plan distributions are due to separation from service in or after the year you reach age 55. But note that this exception does not apply to IRAs. And also the minimum age is 50 if the distribution is made to a qualified public safety officer, such as a police officer or firefighter. Distribution code 2, this is used if the distribution was made as part of a series of substantially equal periodic payments made annually, at least annually, for your life or the joint lives of you and another beneficiary. Code 3, enter this code if the distributions were due to total and permanent disability. Code 4, use this code if it was due to death. Code 5, qualified retirement plan distributions to the extent you have deductible medical expenses that can be claimed on line 4 of Schedule A. Qualified retirement plan distributions made to an alternate payee under a qualified domestic relations order. So if you got divorced and the spouse took half, you would use exception code 6. IRA distributions made to an unemployed individual for health insurance premiums. And I just wanted to point out that we've made this in bold because these apply to IRAs only. So you'd use code 7 if it was an IRA distribution made to an unemployed individual that was used for health insurance, an IRA distribution made for higher education expenses, or an IRA distribution made for a first-time home purchase. And for purposes of this exception, the IRS definition of a first-time home buyer is a person who has not owned a home in the last 2 years. So really, technically, you don't have to be a first-time home buyer. You just can't have owned a home for the last 2 years. Number 10, distributions due to an IRS levy on the qualified retirement plan. So that's the code you use if that's the reason why you have a distribution. Code 11, qualified distributions to reservists while serving on active duty for at least 180 days. So this is an exception I did not list earlier, but it is another reason why you might not have to pay the penalty. If you are a reservist who is serving on active duty for at least 180 days, you are allowed to take money from your retirement account and not pay the penalty on it. 12, any other reason. Use this code, code 12 that is, if more than one exception applies. Also use this code if any of the following apply. The distributions incorrectly indicated as early distribution, code 1J or S in box 7 of 1099R. Include on line 2 the amount that you received when you were age 59 and a half or older. So essentially they say you're subject to a penalty on the form, only you're not. Then you'd use code 12. Or the distributions come from a section 457 plan, which are not from a rollover from a qualified retirement plan. Or your distribution was from a plan maintained by an employer if you separated from service by March 1, 1986 and meet other tests. or the distributions are dividends paid with respect to stock described in Section 404K, or if the distributions come from annuity contracts to the extent that the distributions are allocable to investment in the contract before August 14, 1982. So here is the Form 5329. Form 5329 is actually a multi-page, multi-part form, but when we're referring to this amount or calculating the amount to enter on line 58 with respect to an early distribution from an IRA or a pension plan, you would be filling out Part 1. So we've cut that part out to show it to you. You enter the amount of early distribution on line 1. If you qualify for an exception to the early withdrawal tax, you enter that exception code on the space provided next to line 2. And then on line 2, you enter the amount that is not subject to the penalty because it meets an exception. And then on line 3, you have the amount that is subject to the penalty. And whatever amount you have on line 3, you would typically multiply that by 10%. And the amount that you calculate and enter on line 4 would carry to line 58 of the 1040 form. Now remember, though, that if the amount on line 4 is from a simple IRA, you would multiply the amount on line 3 by 25% instead of 10%. And if there is a Code S in Box 7 of Form 1099-R, then you would need to apply the 25% penalty. Nasty, nasty. So as I told you, Form 5329 is a multi-part form, and I'm going to use this opportunity to describe the other parts of the form for you and what they do. Part 2 is used to calculate the additional tax on certain distributions from education accounts. The designated beneficiary of a Coverdell Education Savings Account, or ESA, can take a distribution at any time. Whether the distributions are tax-free depends in part on whether the distributions are equal to or less than the amount of adjusted qualified education that the beneficiary has in that same tax year. So essentially, a Coverdell ESA is a special savings account that is set up to save for college expenses of a beneficiary. And if the money is withdrawn from that plan to pay for education expenses for that beneficiary, typically it's not taxable. But if the money is distributed and it's not spent on qualified expenses, then a penalty can apply. So line 6, right here, of Part 2. The additional tax does not apply to distributions that are includable as income if, that is, let's suppose you have a beneficiary who took money from a plan, but the money was not spent on education. Typically, you would have a tax that would apply, but there is an exception to that tax, and that is if the payments were made due to death or disability of the beneficiary. So in other words, they're not going to go to college because they either died or because they became disabled, or the distribution was made on account of a tax-free scholarship allowance or payment. So let's just suppose they ultimately don't need to take money from the account for college because they end up getting a tax-free scholarship and don't need the money. Then IRS is saying, yeah, you can take it out and not pay the penalty or pay tax on the money. Or they were made because of attendance by the beneficiary at a U.S. military academy to the extent that the distribution does not exceed the cost of advanced education as defined under Title 10 of the U.S. Code, or were included in income because you used the qualified education expenses to figure the American Opportunity and Lifetime Learning Credits. So it could be the case, and we're kind of moving ahead in the course to a topic you haven't learned about yet, so it could be a little confusing. But if you have a Coverdell ESA, you set up that Coverdell ESA to save money for your college or essentially usually your child's college. And your child comes to a certain age and they're supposed to go to college. Well, if they don't go to college, then typically the income from that plan would be taxable and you'd owe a penalty on the income in that plan. Exceptions to that are the person died or became disabled, or they got a tax-free scholarship, or they joined a military academy and didn't have expense because of that, or they had less expense, those types of things, or that the reason you've made an election to include the distribution in income is simply because you want to claim an education credit. And we'll learn throughout this course that sometimes multiple tax advantages can apply to an individual. It could be that they could take money tax-free from their education IRA, but at the same time, they might also be eligible for an education credit. And it turns out they're way better off taking the credit than they are having a tax-free benefit here. So IRS is saying you can't have a tax-free benefit here and the credit. So if you claim the credit, you're going to have to pay tax on the money that you pull from the account. Well, if you claim the credit and then pull money from the account and pay tax on that money, IRS is saying because you claimed the credit, you don't have to pay the penalty. Parts 3 through 7 of Form 5329 are used to report the additional tax on excess contribution to traditional IRAs, Roth IRAs, Coverdell ESAs, Archer MSAs, and health savings accounts, or HSAs. A 6% penalty is imposed on taxpayers who contribute more to a traditional or Roth IRA than is allowable by statute. A 6% penalty also applies to excess contributions to Coverdell ESAs, Archer MSAs, and health savings accounts, or HSAs. The 6% penalty applies each year the excess amount is allowed to remain in the IRA. Complete Parts 3, 4, 5, 6, or 7 as applicable of Form 5329 to calculate the penalty. So how do you correct an excess contribution? Well, you can avoid the excess contribution penalty if you withdrew the excess by the due date for filing your tax return, including extensions. The withdrawal is treated as a tax-free withdrawal if you do not take a deduction for the contribution and you withdraw any interest or other income earned on the contribution while it was a part of the IRA. So here is Part 3. You can see that is where you enter information relating to the additional tax on excess contributions to a traditional IRA. Part 5 has to do with excess contributions to Archer MSAs. Part 5 relates to additional tax on excess contributions to Coverdell Education Savings Account. Part 6 is the additional tax on excess contributions to a Roth IRA. Part 7 is the additional tax on excess contributions to health savings accounts. The final part of Form 5329 we're going to talk about is Part 8, and that is completed when you are calculating the additional tax on excess accumulation in a qualified retirement account. So this is kind of the opposite of everything else. All the other sections or parts of Form 5329 have to do with taking money out early or using it for a non-qualified purpose. Part 5 has to do with not taking enough out. So IRS doesn't like it when you leave your money in and don't take it out for too long in certain situations as well. So you must begin to receive payments from your qualified retirement plan not later than your required beginning date. The government has established these dates to help ensure that payments are made to you and your beneficiaries. The additional tax is 50% of the excess accumulation. Excess accumulation is the difference between the amount that was required to be distributed and the amount that was actually distributed. So what is a required minimum distribution, or RMD? Well, for an IRA, the annual minimum distribution from traditional IRAs, simple IRAs, and SEP IRAs must begin by the year you reach age 70.5. You can choose to delay receipt of your first distribution until April 1st of the year following the year you reach 70.5, however. Thereafter, though, the required minimum distribution for each year must be made by December 31. And if the first distribution is delayed until April 1 of the following year, then the second distribution must be made by December of that same year. Note that you can elect to have a qualified charitable distribution, or QCD, made by January 31, 2011, and treat that as if it was made in 2010. If you make this election, the QCD will count towards your minimum required distribution for 2010. A QCD is a non-taxable distribution from an IRA of an individual age 70.5 or older, other than a SEP or simple IRA, of up to $100,000, which is made directly by the trustee of the IRA to organizations that are eligible to receive tax-deductible contributions. So let's just suppose you are age 70.5 or older, you have an IRA account, maybe it's worth $500,000, and you're feeling especially generous this year, and you want to make a donation to a charity, a qualifying charity. Then you can have a direct contribution that goes directly from your IRA to that charity, and you won't have to pay tax on that. So that's what a qualified charitable distribution is. Roth IRAs, there are no minimum required distributions during the lifetime of the owner of a Roth IRA. Following the death of the Roth IRA owner, required distribution rules apply to the beneficiary. See Publication 590 for details. Qualified retirement plans other than IRAs. In general, you must begin receiving distributions from your plan no later than April 1st, following the later of the year in which you reach age 70.5, or B, the year in which you retire, even if you are over age 70.5. There is an exception. If you owned more than 5% of the employer maintaining the plan, you must begin receiving distributions no later than April 1 of the year following the year in which you reach age 70.5, regardless of when you retire. Note that the required minimum distributions were waived in 2009, so in 2009 you did have the option to forego taking your required minimum distribution, but you are, however, required to take a 2010 minimum distribution by the end of 2010. So let's take a look at the next topic, which is annuity income. And there is an old rule called the general rule that people used to use to figure the taxable portion of annuity income. But that rule was done away with or replaced way back in 1986. And really no one uses the general rule in practical application anymore. But the IRS does still say that you can use the general rule to calculate the taxable part of your pension or annuity if your annuity starting date is before 1996, before November 19, 1996, and after July 1, 1986, and you do not use the simplified general rule. You must use the general rule to calculate the taxable part of your pension or annuity if you receive your annuity from a non-qualified plan or a qualified plan if you are age 75 or older on the annuity starting date, and your annuity payments are guaranteed for at least 5 years. Now, I should tell you that it is likely you will never use the general rule when calculating the taxable portion of a distribution. A couple of years ago, I actually went and looked up the instructions for the general rule, and the general rule really literally took up an entire IRS publication. So I decided there was no point in me even learning how to do it because I had really never had a client who was required to use it, and it would be so arduous. So really, point being here today that when you are trying to figure the taxable portion of an annuity, it is more than likely the case you will do so using the simplified method, and that is what I'm about to teach you. So simplified method. Under the simplified method, you figure the tax-free part of each monthly annuity payment by dividing your cost by the total number of expected monthly payments. If your annuity is payable for your life alone, use Table 1 at the bottom of the simplified method worksheet. If your annuity is payable for the lives of more than one annuitant, use Table 2 at the bottom of the worksheet. In either situation, the worksheet asks you the age at the annuity start date and not the recipient's current age. If you receive more than one annuity and at least one of them is not fully taxable, enter the total amount received from all annuities on line 16A of Form 1040 or line 12A of Form 1040A. And here is an illustration of how the simplified method works. Bill Smith, age 65, began receiving retirement benefits in 2010 under a joint and survivor annuity. Bill's annuity starting date is January 1, 2010. The benefits are to be paid for the joint lives of Bill and his wife, Kathy, who is age 65. Bill contributed $31,000 to a qualified plan and had received no distribution before the annuity start date. Bill received the following statement: figure his taxable distribution using the simplified method worksheet as shown next. So here we have it, Bill Smith. He has a gross annuity amount that he received for the year of $14,400. Federal taxes of $800 were withheld. He had state tax withheld of $400, and his original contributions to the plan were $31,000. The distribution code is 7. That means normal non-disability distribution. You will see that this statement does not look anything like a 1099-R. This statement, as you see right here, comes from the Office of Personnel Management. That is the federal government. So if you are doing a tax return for a person who is retired from the post office or retired from the IRS, or other types of federal civilian government positions, it is very likely that they will receive an annuity statement that looks like this rather than the 1099-R we saw earlier. If they have an annuity from the government, then it is more than likely you will need to do the simplified method worksheet to figure out the taxable portion of the distribution. And so we're going to take a look at Bill Smith. Remember that the total distribution he received from his annuity for the year is $14,400, and our job is to figure out how much of that distribution is taxable. On line 2, we enter his cost in the plan. How do we know that? It shows us the cost in the plan right here, his original contributions, $31,000. So that number of $31,000 carries to line 2. Then on line 3, it says enter the appropriate number from table 1 below. And what we look at is what is the combined ages of Bill and his wife Kathy on the annuity starting date. He was 65, she was 65. We add those numbers together and we get 130. We then go down and see where 130 falls, and it falls on this line in table 2. Combined ages are 121 to 130. The combined age is 130. That means that we have 310 as the number that is going to get carried up to line 3 and entered here on the worksheet. We then divide line 3 into line 2, and by sheer coincidence, we've rounded out at a very perfectly round number of $100 or 100.00. We then multiply line 4 by the number of months for which this year's payments were made. Well, there were 12 payments made during the year, so we're going to take 12, multiply that by 100, and we get $1,200. $1,200 is the amount withdrawn from the plan during the year that is not taxable because it is a return of cost in the plan. So the total distributions from the plan were $31,000. We're going to subtract $1,200, and that means that $13,200 is taxable and $1,200 is non-taxable. So we've got a gross distribution of $14,400. We enter on line 16A of the 1040 form, and of that, $13,200 is actually taxable. So that concludes the lecture portion of today's class. There are 2 classwork assignments, one easy, one a little bit more difficult for you to complete today. The first assignment involves preparing Form 5329 for Jane, taxpayer. She has purchased her first home. She withdrew money from her IRA to make the $20,000 payment on her home 100 days before she purchased it. So she's within that 120-day window. That is good. We also see here that the IRA box is checked, and that's crucially important because if she had withdrawn the money from a pension plan, she would not meet an exception to the penalty. So she does meet an exception to the penalty. Please prepare her Form 5329. And when you are finished preparing her Form 5329, please resume playback of this video for a review of the answer key. So at this point, please push pause. When you are ready, resume playback for a review of the answer key. So if you have finished working on classwork assignment number 1, here is the answer key for it. You can and should know that there is a limit on the amount of money you can take from an IRA for purposes of purchasing a first home that is accepted from the penalty, and that limit is $10,000. So Jane withdrew $20,000 from her IRA. However, the exception to the penalty applies only to the first $10,000. So let's see how that worked out on her Form 5329. On line 1, we enter the amount she took as a distribution, which is $20,000. On line 2, we enter the exception code, which is code 09. And the amount that qualifies for an exception to the penalty is $10,000. That leaves $10,000 that does not qualify for the exception. So the penalty is going to be $1,000 or 10% of the excess amount. So that concludes the review of the Session 5 Classwork 1 homework assignment, or Classwork assignment rather. Let's move on now to Classwork number 2, which is a little bit more work for you. Classwork number 2, the forms you will need to complete this assignment include Form 1040, Form 8606, and Form 5329. Jack, taxpayer, is age 50 and single. He took an early distribution from his IRA during the year because he lost his job. His total cost basis in all IRAs at the end of 2009 was $50,000. He made no contributions to any IRA for 2010. Jack spent $2,000 for health insurance while he was unemployed, and he received the attached tax documents for the year. He will receive a $400 credit from his Schedule M. Prepare his tax return. So let's see what we have here. We have a 5498. It is not showing any contributions to his IRA for the year, but it is showing the year-end fair market value and the fact that this is a traditional IRA. Next, we have the 1099-R. We see that it is from an IRA. The IRA box is checked. Distribution amount is $20,000. The taxable amount is also showing as $20,000, but the taxable amount not determined box is checked. So, what does that mean? Essentially, he has a cost basis, and it's going to be your job to fill out his 8606 and determine whether the taxable amount is $20,000 or something less than that. Moving over, we also have a W-2 for $30,000. Go ahead and prepare Jack's tax return. So at this point, please push pause, and when you are finished working on this assignment, please resume playback for a review of the answer key. And I estimate you should allow yourself at least 20 minutes to really work through this problem properly. And when you are done, we'll review the answer key. Okay, if you have finished preparing a tax return for Jack, I now have the answer key up for you, and the password to unlock this answer key is Welsh. So the Session 5 Classwork answer key password is Welsh, W-E-L-S-H. And let's take a look at this answer key. Jack took a distribution from his traditional IRA, and since he has a basis in the IRA, he's going to use Form 8606 to figure the taxable part of the distribution. He is under age 59.5, so he is subject to an early distribution penalty on the withdrawal he took from his IRA unless he qualifies for an exception. The IRA distribution was used to pay for health insurance while he was unemployed, so he does have a qualifying exception. We need to begin by completing Form 8606 for Jack to determine the taxable part of his IRA, and we then go on to Form 5329 to figure his early distribution penalty. So let's take a look at these two forms. And we'll begin with the Form 8606. And we can see here that the amount that he has as a basis in the plan is $50,000, and that the 5498 form he had at the end of the year showed his fair market value at the end of the year is $100,000. So we then take the distribution amount, which was $20,000, and add that to the fair market value at the end of the year, and we get $120,000. We then take 20, or the amount that appears on line 5, which is 50, and divide that by the amount that appears on line 9, which is 120. And when we do that, we get 41.67%. So essentially, 41% of the value of the fund is basis, and 60% of the value of the fund is growth in the fund and would be taxable on distribution. So we're going to take that 41.67% and multiply that by the amount on line 7, 20,000, and we get $8,334. That is the non-taxable part of the distribution. And of course, we subtract that from 20,000 and we get $11,666. That is the taxable portion of the distribution. And on line 14, what we have is $41,066. And for any future distributions from his IRA, that would be the amount to start with, say, in 2011. So he has now reduced his basis in his IRA from 50 down to 41,666 because he has removed or distributed 8334 tax-free. Let's go back up to the 5329 next, because we have established that the taxable portion of his distribution is 11,666. That's going to be the starting point for the 5329 form. And we're going to enter 11,666 on line 1. How much did he spend on health insurance? Well, he spent $2,000 on health insurance while he was unemployed. We enter 2,000 on line 2. We enter the exception code of 7. We subtract 2 from the total taxable distributions, and we get 9666. And the difference, that 9666, is still subject to the penalty. The penalty is 10% and comes out at $967. So how does the 1040 look when we're all finished? I'll just scroll back up to page 1. We enter $30,000 of wage income on line 7. By the way, he is single, and we've entered that single filing status. $30,000 of wage income on line 7, $20,000 of distributions from an IRA, of which $11,666 is taxable, giving our filer $41,666 of adjusted gross income. We claim a standard deduction of $5,700, a personal exemption of $3,650, taxable income is $32,316, and the tax is $4,430. But we're not done. We have to add the additional tax of $967 in. That raises his total tax to $5,397, and we then show that he had $5,500 withheld plus a making work pay credit of $4,400. That leaves him with a $503 refund. So that concludes the review of the Session 5 Classwork answer key. Let's move on and take a look at the homework assignment for Session 5. We're going to be giving you more opportunities to work through the Social Security benefits worksheet with this particular assignment involving Fred and Wilma Flintstone. They're both married. They have 1099-Rs. They have some interest income. They also have, you should note that the U.S. bond interest was not spent on higher education. They are not receiving a making work pay credit because they had no earned income. Here is Fred's Social Security statement. Here is Fred's pension statement. Wilma has a Social Security statement. She also has a pension statement. And your job is to prepare their tax return. There is a second tax return assignment for Session 5. That is Homework B. This one involves Betty Rubble. She is filing married filing separate. Her husband Barney does not itemize his deductions. During the year, Betty received $1,500 of interest income from Port of Seattle bonds. She also cashed in and received $500 of interest on her Series EE savings bonds. In February 2010, Betty began full-time studies at Texas A&M University. She withdrew $4,000 from her IRA, of which she spent $3,000 on tuition and fees. Her 1099-R is attached. So go ahead and prepare Betty's tax return. So that concludes Session 5 of the Basic Tax course. Thank you for participating. Have fun doing your homework assignments, and I will see you back at the beginning of Session 6. The Session 6 topic will be adjustments to income, and I always like to talk about deductions. Thank you, and bye-bye.